I did have a question that came in earlier via email today from Eileen, and it wasn't related. I don't think she's on the webinar. And it was a basic question, but it was something that she was a little bit confused about. I'm going to go to the custom spread tool, and I'm going to pull up a position on NTR. And we're going to go 60 days out. It's right at around $100 per share, 99.65. But we're going to go 60 days out to May expiration. And we're going to look at an out-of-the-money call. The 110 call midpoint's a little bit under $3 there. And we're going to go ahead and look at buying this position. Just one contract to keep the math simple. All right, so it's let's just put it at $3 to keep the math even more simple. I wouldn't get that price, but we'll just use the $3 price there. Okay. Now, simple profit and loss chart on this position. We know that, of course, if the stock stays below 110, we hold this call all the way to expiration, we're going to lose the full amount. Our break even's at 113. We need to cover the strike price at 110 plus the $3 purchase. Again, if we hold it all the way to expiration. Now, Eileen's question was fairly simple. She hasn't done a lot of call buying or put buying before. She was mostly selling options, doing spreads, and she's done calendar spreads, I believe, as well. But in any case, when you look at the profit and loss chart, you see the break even here at 113. Her concern was that, well, I can't make any money until the stock's above 113 at the break even price. That's true. If the position is held all the way to expiration and you didn't close it beforehand, what do we know about this option? Well, let's just go to the research tool here. And anytime I'm on a chain, anytime I'm on a search, we can use the edit more information button, the little blue button there, and we can delve into the option or the stock itself. Now, the option research page, what it shows us is a simple graph here of the option bid versus changes in implied volatility since the option was released on the market. And this particular May option was released right after standard February expiration. So it looks like 2/25, 2022 is when this May series for NTR was released on the market. And there's some things you can change here. You can change this to be the option last price versus the bid, the stock price versus volume, so on and so forth, delta versus implied volatility, however you want to go into that analysis. But down below, what I wanted to take a quick look at here, well, we can see the current implied volatility and the current percent implied volatility range. But this gives me here perfect gauge of where it was earlier today. The delta's right around 0.3 on this position. So, to Eileen's question now, is that does the stock need to go up to 110 or to 113 before we start making money? No, if the stock goes up 1 point by tomorrow, or on Monday, my apologies, if it goes up 1 point on Monday to $100.65, we'd expect the option price to gain 30 cents. It'd be about a 10% increase in the position. And of course, then delta would change. It might move up to 0.32. And so if it moves up another dollar, we'd make another 32 cents. We'd be at $3.62, about a 20% gain on our initial $3 purchase price. Of course, however, if the stock falls in the next few days, we're going to expect to lose 30 cents, then maybe 32 cents, or I'm sorry, 28 cents, as the option will be going less and less as it moves to the downside. And so if it does drop down to 97, that means we're going to see more of a move in order for the stock and this call, to get back to that $3 price range. But again, yes, you don't expect to hold it all the way to expiration. You can see a profit well before that. You want to know the delta. You want to know the movement expected on your long call. But of course, if the stock doesn't do anything, we're going to go to calculators now, and we're going to go to Black-Scholes. This is an out-of-the-money call. And what this is showing us is the expected time decay. Of course, if the stock stays at the same price, and in this type of volatile market, we don't expect the stocks to stay at the same price. But if it goes 30 days out to April 17th, we'd expect to lose half of this price. If the stock just waffles around this $100 price range, moves up 40 cents, moves down 60 cents, goes up 35 cents, drops 25, it's still holding somewhere around this $99.50 range or $100 range. Yes, in 30 days, we're going to expect to lose half of that time value decay, and then it's going to start accelerating quicker. What that means is if it does waffle for those first 30 days, and we're here at a price point of about $1.50, and it hasn't moved too much, we've lost half of the time value that we paid into this position. This whole option price, since it's out of the money, of course, is all time or all extrinsic value. That can fluctuate with changes in volatility as well. But if the stock's not moving, we're probably not going to see much change in volatility. So what does this mean here? Well, here your delta is still probably going to be around maybe 0.25. You've already lost $1.50 of what you paid into the position, which means now you're going to need to see more movement much faster, probably up to the 105, 106 range before you get back, hopefully, to that $3 price range where you'd be at break even, and then a little higher as you're getting closer to expiration in order to get any type of profit that you wanted to see on that position. So yes, you can see instant profits right away if the stock moves up as you expect within the first day, 2 days, 5 days, or 10 days. Is it the profit that you want for the strategy? Maybe not. Maybe you're targeting a 70% profit or 80% profit on your long calls. But if it takes too long to get to that price, or if you're buying a weekly option, which is very short term, and you're going to start seeing more, it'll cost less, but you're going to start seeing more rapid time decay. As long as the stock moves up, you should see some profit on the position right away if it moves in the direction that you want. Same thing with the put. If I buy an out of the money put, if the stock falls within the first 3 or 4 days, I should be able to see a reasonable and expected profit on the position. But again, if it stagnates, you're fighting that time, and then you're going to need more of a movement to get back to that break-even price in those cases. Now, another aspect of this is, let's go ahead and close that out. Another aspect of this, of course, is how can we know what to expect? Meaning that if the stock did move up as we expected very gradually, and say it moved up to our strike price of 110 and was trading at 110 in the first 30 days, what could we expect our price of our option would be? Well, the easiest way to do that is to do it right here from the custom spread tool or the profit and loss chart. So we'll just go out here and I'll say, okay, what happens if my stock does move up to 110 on or around April 18th, 30 days from today, roughly. And we see here that the expected value would be about 531. We're taking advantage now of the ATM bell curve. Our option is right out of the money. I'm sorry, right at the money. The extrinsic value is swelling. So we're getting the benefit of the ATM bell curve, and we do still have some time remaining on the position. So we have, I guess that's close to a 75% profit on this particular trade. But of course, again, if it's only gone up to say 104 or 105, we're going to be at a profit still, but we're only talking about 2% on this position. The original purchase price of $3, the expected value of 306. Another way that you can quickly gauge, of course, of the expectations of the value of your option. If I buy a 60-day out option and 30 days have passed, and if the stock's my call is 1 strike out of the money or 2 strikes out of the money remaining, what would my expectations be? Well, in this case, what I do is I could just go to the option chain as well. And we're just going to go to April, standard April expiration, it's about 30 days out. And we're going to hold that for the time being, and then we'll add in the May series also. Now, why am I doing this? Well, we're looking at this 110 call, roughly at about $3 midpoint pricing. And we're 2 strikes out of the money. Stock's essentially at $100 per share. So we're roughly 2 strikes out of the money. But if 30 days passed and the stock was trading at 105 and we're still 1 strike out of the money, well, we could compare that to maybe the price here at about 210 for the 105 for April. Why? Because that's 27 days right now, assuming volatility remains about the same. So 30 days to expiration on this stock, similar volatility, 1 strike out of the money, expect it to be around $2, $2.05 or $2.10. If it's right at the money, well, that's about $4 with 30 days left. We saw $5.31 on the Black-Scholes pricing model. That's probably due to a difference in implied volatility. Yeah, see, this is at 0.4062 when we ran that calculate expected profit and loss, whereas the closer options are at 0.38, 0.39. That does make a difference, and that's why we were seeing a $5.31 expected price instead of $4, just for a subtle shift in implied volatility in those cases. So that was just to answer Eileen's question. The break even that you see on the profit and loss chart, this is just the break even at expiration. I'd say 99% of the call and put buyers that I talk to that are power options subscribers have no intention, of course, of holding the long call or the long put that they bought for speculating market movements up or down to anywhere near the full expiration date. Unless maybe you're trading a weekly, that I understand. But most are buying 30, 40, 50 days at a time, some even 90. And, if we're doing calendar spreads, we might be 150 to 200 days at a time. We don't plan on holding the option all the way to expiration in most cases. We have a target that we want to get out at, whatever percent we've set for our trading plan for the long call or long put portion in our portfolio. And if that's hit during the trade, we may sell half of it. We might even ladder some positions. I know some investors that do that. I typically don't. Ernie does from time to time. What laddering means is if I bought the 110 here on NTR and it exceeded expectations, and next week it's up to 115, well, I might keep the 110s I have, but buy another 4 or 5 120s, for example, laddering up in that case. If I had 10 contracts here at 110, I might sell half of those and then buy a higher strike if I'm still bullish on the stock and expect it to go up. Again, Ernie does that. I don't typically do that. I'll just typically sell half and then leave the rest remaining open in that case. Different approaches, of course. And depending on the stock, it's not necessarily that one's better than the other, because sometimes you have the good stock that's outperforming and you really can't do any wrong with it. And sometimes you have the stock that just doesn't do what you want at all. And you end up having to closing it to try to minimize it to only a 50% or so of the maximum loss on the trade.